I've separated freehold property proceeds from other proceeds. And I asked that, what is the reason for this separation? Why am I asking this question? I want to understand if the student is even following. For somebody not on class last week, it's understandable. Now, if I now know that all the students were not on class last week, I can now know how to deal with this. What's the basis for separating proceeds from properties, freehold properties from other proceeds? Anybody, any response? Okay. Now, my last class, in fact, not my last class, my upper class, we explain how the proceeds from liquidated assets should be distributed. We explain how the proceeds from liquidated assets should be distributed. Please look at this. Examiner says non-current liabilities, 10% loan note secured on freehold property. We refer to this as fixed charge, where a liability is secured on the particular asset of a company. That's a fixed charge. Where a liability is secured on a particular asset of a company, that's called fixed charge. In the event that that company is liquidated, excuse me, please. In the event that that company is liquidated, any proceeds realized from that asset must be applied to settle that particular liability. In this question, we have 10% loan note secured on freehold property. Examiner also says the overdraft facility at present stands at 45 million and carries a second charge on the company's freehold properties. In this question, two liabilities are secured on freehold property. We have loan note liability, we have bank overdraft liability. For loan notes, we have the first charge. Overdraft facility, we have the second charge. Now, where a liability or where liabilities are secured on a particular asset, that's what we call fixed charge. Now, if this company is liquidated, money realized from freehold property will be applied to settle the liability of loan notes and that. That is why we separated this proceed. Proceed from other assets, plant and machinery, plants, inventory, receivables. These proceeds are not secured on any asset. We separated it. Remember the question. If this company is liquidated, how much will the bank get? If the company is liquidated, we are going to realize 65 million and 87 million. When we realize this cash, the proceeds from the freehold property will be used to repay the 50 million. That means out of 65 million, you are going to pay 50 million. You are left with what, please? We are left with what?
Out of what, sir?
We are left with what, please?
Out of what, sir?
Can you hear me?
We can hear you, sir. What was the question, sir?
Okay. That means you can't hear me.
We can hear you now, sir.
The proceeds from property is 65 million. This property has been used as collateral for two liabilities. Let me go back to it. Okay, look at it. 10 non-current liabilities, 10% loan note secured on freehold property. The value of the loan note is 50 million. Also look at it. The bank overdraft facility at present stands at 45 million and carries a second charge on the company freehold property. And I explained that where a liability or liabilities are secured on a particular asset, that is what we call fees charge. Where a liability or liabilities secured on a particular asset of the company, that is called fees charge. Now, what are the implications of fees charge? In the event that the company cannot pay back that liability, and the company is to be liquidated, any proceed realized from that asset must be applied to settle the liabilities. I went further to explain that if this company is liquidated, we are told that the company can realize this cash. Property company will realize 65 million. Plants 21 million. Inventory 40 million. Receivables 26 million. And I asked a question at the first time. Why do we separate the proceeds from property from other proceeds? I asked this question. I didn't get any response. So I assumed that no student was in class last week. And that's okay. Why we separated this was because freehold property is a fixed charge asset. Any proceed realized from this asset must be applied to the liability involved. And now move to the next stage. The proceeds from the freehold property will be used to repay the 10% loan notes. Why? This property has been used as a collateral security for loan notes and bank overdraft. This freehold property has been used as collateral security for the loan notes and bank overdraft. However, examiner says loan notes we have the first charge, bank overdraft we have the second charge. And I ask a question, second question. Out of 65 million, we repay 50 million. We are left with what?
15 million.
15 million. Look at it. The remaining 15 million will be used to repay some of the overdraft. How much is the bank overdraft? How much is the bank overdraft?
$45 million.
5 million.
45 million.
Yes, sir.
I was just trying to go back to it. Look at it. Examiner says the overdraft facility at present stands at 45 million and carries a second charge on the company's freehold property. That means after you have settled the loan notes, 50 million, look at it. 10% loan note secured on freehold property. Settle the 50 million. Out of 65 million, we have settled 50 million. We now move to the second charge. Bank overdraft 45 million. Look at it. The remaining 15 million will be used to repay some of the overdraft. Out of 45 million, we have repaid how much? 15 million. We are left with what? Out of 45 million overdraft, we repay bank 15 million. We are left with what?
With 30 million.
30 million.
Mm-hmm.
Now the next question is, how would the bank claim this 30 million? How would the bank claim the 30 million? Please note, bank cannot come here and claim 30 million. Bank will now rank alongside other ons. That means bank will claim 30 million as an unsecured creditor. You cannot come and take 30 million from here. The asset is not sufficient. The proceeds from the asset, the proceeds from freehold property is not sufficient to settle the liabilities. In this case, bank cannot claim that 30 million directly, but bank can rank as alongside other unsecured creditors. bank will now go and join unsecured creditors in order to claim the balance. When we have this lecture, at our first lecture, we explain how the proceeds will be distributed. Can we recall? We said the proceeds from liquidated asset will be distributed as follows. 1, preferential creditors. Also called preferential payables. Who are the preferential creditors? This includes unpaid wages, unpaid pensions, unpaid taxes. This represents preferential creditors. Then we move to fixed charge secure creditors. After fixed charge, we move to floating charge secure creditors. After floating, we move to redundancy payments. Then we move to unsecured creditors. Then you have preference shareholders. Then you have ordinary shareholders. These are the orders of distribution. And I emphasize that between preferential creditors and fixed charge, there could be conflicts. Where an asset has been used as security for a liability, where a company's asset has been used as collateral, that asset cannot be applied to another liability. You observe that technically, secure creditor will get their money first. Fixed charge secure creditors. 2, secure creditors, loan notes, secure creditors, bank overdraft partly. From the proceeds of that asset, if the secure asset is not sufficient to settle the liabilities, then the creditor becomes unsecured creditors. If the proceeds from secure assets is not sufficient to settle the liabilities, then the creditors become unsecured creditors. In this case, bank becomes unsecured creditors to claim 30 million outstanding balance. We have distributed 65 million. We are left with 87 million. We have distributed 65 million. We are left with what? We are left with 87 million. We now ask ourselves, do we have preferential payables in this question? In this question, do we have preferential payables? Go check the question. What we are trying to do is the order of distribution. The company is assumed to have been liquidated. We have realized money. How do we share the money? Yes, my question to the class. Do we have preferential creditors in this question? I'm sure I read the question out. Examiner says preferential payables included in the statement of financial figures for payables. Out of these sundry payables, 117 million, 27 million of it is preferential payables. Based on the law of distribution, preferential payable must be settled. That means out of this 87 million, we are going to settle preferential payables. 87 million minus 27 million. We are left with 60 million. If you are following the class, if the company is liquidated, we have settled fees charge, secure creditors. We have settled preferential creditors. Who is next? We have 60 million naira remaining. Who is going to collect next? The next person is floating charge secure creditors. In this question, there is no floating charge. In this question, there's no floating charge. Next, you have redundancy payments. If you are liquidating a company, the employees will be rendered redundant. So if the company is making provision for the employees, that becomes redundancy payment. In this question, there is no redundancy payment. Next, we now move to unsecured creditors. Unsecured creditors, that is number 5 on the list, unsecured creditors. Now check it out. We have bank overdraft unsecured. Bank will claim 30 million. The 30 million outstanding as unsecured. We also have other sundry payables. This should be other sundry payables or other sundry creditors, whichever one you want to use. Other sundry payables. Where is this coming from? Go back to the liability. If a company is liquidated, the next thing is to settle the liabilities. Look at the liabilities. Non-current liability, we have settled this. Current liability, bank overdraft, we have settled 15 million. Out of bank overdraft, we are left with 30 million. Sundry payables, out of this, we have settled 27 million. Please, 117 million minus 27 million, how much?
$90 million, sir.
$90 million.
Yes, sir.
Look at it here. Other sundry payable 90 million. So total unsecured creditors 30 plus 90, 120 million. We have 60 million naira and we need to settle 120 million. Can it go round? We have 60 million naira. And we need to settle 120 million. Will this be sufficient?
No,
Definitely no. Now ask yourself, okay, how do we share it? We have to prorate. How do we do? We have to just prorate the money. We need to prorate the money between bank overdraft and other Sunday payable. That means out of this money, bank will get 30 million over 120 multiplied by 60 million. Bank will get 30 over 120 multiplied by the 60 million. Bank will get 15 million. Other Sunday payable will get the balance. But we get 15 million. The balance go to other Sunday payables. But that is not my business. Examiner says, what will Able Bank get? If the company is liquidated, Able Bank will receive 50. Remember, the bank has gotten 15 million before from here. Again, the bank will get 15 million from here. Able Bank will receive secure part of overdraft 15 million, unsecured part of overdraft 15 million. If this company is liquidated, Able Bank will million naira. Under proposal A, bank will get 30 million naira. We are done with proposal A. Under proposal A, bank will get 30 million naira. It's too much. And proposal A is if the company is liquidated. Proposal A is if the company is liquidated. We see our proposal B and C. We have just done proposal A. Any question, please? This should be my third lecture. This is the third lecture. Any question, please? Look at proposal B. Look at proposal B. Tayo Limited has made an offer to take over the entire business activities of PL. Under the terms of the offer, Able Bank will receive 80% of the balance due, but repayment will not be made until exactly 1 year from the date of the creditors' meeting. Now, how much will Able Bank get under proposal B? 80% of the balance due. Please, what is the balance of overdraft due to Able Bank? You can type in your answer.
$45 million, sir.
45 million. Please compute 80% of 45 million.
80%?
And here, look at the question. 80% of balance due.
That's 36 million. No?
So, under proposal B, Able Bank will get 36 million. But they have to wait for how many years? Look at the question, it's on your screen. Repayment will not be made until
You have to wait for
exactly
12 months, 12 years.
Until exactly 1 year. Look at it.
12
Able Bank will receive 80% of the balance due, but repayment would not be made until exactly 1 year from the date of the creditors' meeting. That means they will wait for 1 year. Under Proposal 1, Able Bank will get 30 million naira immediately. Under Proposal 2, look at Proposal 2. Let me expand that also. Reconstruction is always a bonus. Look at Proposal 2. Able Bank will receive 80% of 45 million, 36 million, but only in 1 year's time. Is that clear, please?
It's clear, sir.
We move to Proposal 3. Let's look at Proposal 3 together. Proposal C, reorganization and capital reconstruction. The management of PL is the company in question, Second Limited, is planning a reorganization of the company's activity, which will restore profitability to reasonable level almost immediately. The reorganization will be linked with a capital reconstruction scheme. Under this scheme, look at the scheme. Existing shareholders will be asked to accept 2 1 naira shares in exchange for every 5 shares currently held. Please interpret that to yourself. Imagine you are a shareholder. Existing shareholder will be asked to accept 2 1 naira shares in exchange for every 5 currently held. That means if you have 5 shares, we are going to tell you to accept 2 shares for 5. Technically, your share value will reduce. If you have 1,000 shares in the company before, 2 for 5. So your 5 shares is now equivalent to 2 shares. We need to treat that first. That is 1. Let's treat that. You now ask yourself, How many shares do we have in this company currently? How many shares? Let's go to the equity. Issued share capital in bracket 1 naira each, 50 million. So how many shares do we have in this company? The line is open. You can send in your answer.
50 million.
Now, examiner says 2 for every 5 shares currently held. You are going to accept 2 shares for 5. Let's go to the workings. I'll just expand small. Now look at it. Reconstruction scheme. Let me start with this. Receivable by shareholders, 2 for 5. 50 million. This computes 2 over 5 for 50 million shares. How many shares remaining?
20 million.
That means the investment that was 50 million naira has been reduced to 20 million naira. The shareholders' investments that was 50 million naira. The directors are saying, look, accept 2 shares for 5 shares currently held. That investment will reduce to 20 million naira. Is that clear, please? That investment will lead to 20 million naira. We have treated proposal 1. We have treated note 1. This is your note 1. Shares receivable by shareholder to 1/5 of 50 million. That becomes 20 million. Let's continue. The bank will be asked to accept 10 million shares, 10 million, 1 naira shares as consideration for 1/2 of the present overdraft. Please, what is 1/2 of the present overdraft? Please compose. What is 1/2 of the present overdraft? Our present overdraft is 45 million. Please compose 1/2 of it.
22.
20.5 million.
22.5 million. Thank you. So this company is saying bank will be asked to accept 10 million, 1 naira shares as consideration for 1/2 of the present overdraft. What this means is that half of the overdraft will be converted to ordinary shares. Look at it. Conversion of debt. Overdraft debt is a debt. So ordinary shares. We can treat that. Look at it. shares receivable by Able Bank, 10 million naira worth of shares. $10 million worth of shares. Might not need this. Undo. Go back to your place. That means bank is only left with overdraft of 22.5 million. If this proposal is accepted, right? We have converted 1/2 to ordinary shares. Bank is left with 1/2. The remainder. Is that clear, please? Is that clear, please? Look at it. It's not me that is making the proposal. The bank will be asked to accept 10 million naira shares as consideration for 1/2. So compute 1/2, convert it to ordinary shares. The remaining 1/2 represent overdraft. That means overdraft balance, remaining overdraft balance is 22.5 million naira. Based on this proposal. Look at the next line. If this proposal is acceptable to creditors, the shareholders have indicated their willingness to take up a further 30 million naira shares for cash. That means existing shareholder will subscribe for more shares in the company, and they are going to provide 30 million naira. Look at the treatment here. Issue for cash. New shares issue for cash, 30 million. Total shares in the company at 1 naira, 60 million shares in the company. The question continues. The balance remaining outstanding to the bank. What is the balance remaining outstanding to the bank? We have converted 1/2 to ordinary shares. The balance remaining is 22.5 million. Bank will be repaid from the proceeds of this issue. That means bank will get a cash of 22.5 million naira under reconstruction. Then bank will have equity shares in the company that are worth 10 million naira. Under proposal C, bank will get a cash of 22.5 million immediately. What other things? Look at the last aspect. The directors are confident that if this proposal is put into effect, profit of 40.5 million per annum will be earned for the foreseeable future. of which 2/3 will be paid out as dividends. Remember that under reconstruction, bank is now part of the shareholders. That means bank will also receive dividends. Under reconstruction, bank is part of the shareholders. Bank will also receive dividends. Examiner says, of which 2/3, out of this profit, 2/3 will be paid out as dividends. Let's calculate dividend payouts. Please compute 2/3 of 40.5 million. What do you have? Yes. Let me expand it a bit. Yeah. Dividend to shareholders, 2/3 of 40.5 million. What do you have, please? The class is a bit passive tonight.
27 million, sir.
27 million.
Yes, sir.
Now, out of this 27 million, this dividend to shareholders, how much will Able Bank get? You now come here. Able Bank has 10 million shares out of 60 million. So 10 over 60. It's also 1 over 6. Please compute. Able Bank has 10 million shares out of 60 million shares in the company. That is how the dividend will be shared. Able Bank will receive 10 million over 60 multiplied by 27 million. Able Bank will get 4.5 million as dividends. The first dividend will be received after 1 year. Further dividends should be expected in subsequent year. We are done with the question A. Look at the summary. Look at the summary. Under proposal A, if this company is liquidated, Able Bank will get 30 million naira immediately. That is cash now. Nothing in year 1 under proposal A, nothing in subsequent year. Under proposal B, that is Tayo Limited offer. Able Bank will not get anything immediately. Able Bank will get 36 million in year 1. Nothing in subsequent year. Under proposal C, Able Bank will get 22 million naira immediately. That's year 0. Then dividends in year 1, 4.5 million. And dividend in subsequent years. Examiners say under each of the proposal, what will Able Bank get? We have answered A part of the question. We have answered the A part of the question. Now let me ask the class. Which proposal should the bank accept? Bank can only accept one. Should they accept? Bank can only accept one proposal. Should the bank accept proposal A or B or C? The class is open. You can unmute. Everybody is silent.
So I think C, proposal C.
Thank you. Who is speaking? Sorry, let me put a name to it.
It's Prosper.
I wanted to say, I know you were online last week. Fidelis was online last week. Even Deborah was online. All right. Let's unmute. Okay, you want to speak, believe.
So I think it's 30,000 naira.
Proposal
That's
A,
proposal.
right?
Yeah, proposal A.
Now, if you are faced with a question like that, you cannot make decision. You cannot make any decision, or you cannot make any recommendation until you bring everything to their present value. Cash flow in year 0, 30 million. Cash flow in year 1, 36 million. We need to know, because we have cash flow at different time, at differing period, we cannot compare. Because we have cash flows at differing period, we need to bring all the cash flow to their present value. It is that present value now we are now going to compare. As it is now, you cannot make any recommendation. You have to look at it from the angle of a professional. That look, wait, Somebody is giving you 30 million naira now and 36 million in 1 year. I can't compare. I need to bring them to their present value first. Somebody say, I'm going to give you 22.5 million now and 4 million in 1 year, 4.5 million in 1 year. And in subsequent year, you still get more money. Then I must bring all the cash flows to their present value. That takes us to the B part of the question. Look at the B part of the question. Explain the relative financial merits of the proposals from the viewpoint of Able Bank. For you to explain the relative financial merits, you must discount the cash flow to their present value. Look at the notes you are giving. Assume that the bank earns 15% per annum on all its lending. That means the bank rate of return is 15%. That becomes your discount factor. You can now go to the B. Look at the comment, please. It's too much. The returns from the three proposals may be compared by calculating their present value using the given interest rates, that is return on bank, 15%. Look at proposal 1. Amount due in year 0, 30 million. What is the present value of cash flow in year 0? It is also the cash flow. That not correct?
That's correct.
Present value of cash flow in year 1, Tayo Limited offer. Please compute at 15% discount rate. Please compute, let's know. Get the discount factor for us, forget this. Let me have the discount factor. 15% discount factor year 1. What do you have, please? Oh, yeah. %15 discount factor year 1 supply. I'm asking the class. You can't compute. That should give us 0.870. Please multiply by 36 million. What do you have? What's the present value? $36 million multiplied by 0.870. What do you have, please? You can see that
$31,320 million.
okay. 320, no problem. Proposal C. Bank will get 22 million in year 0. Cash in year 0. The present value is also 22 million. Year 0, we are going to get 22 million. The present value is still 22 million. Dividend from year 1 to infinity. Bank will get dividend of 4.5 million naira in year 1 and to infinity. How do we get that? Examiner says a profit of 40.5 million will be achieved for the foreseeable future. That means that profit is not for 1 year. It's for many years. Foreseeable future. That means that dividend of 4.5 million is from year 1 to perpetuity. That dividend of 4.5 million is from year 1 to infinity. How do we calculate present value of cash flow from year 1 to infinity? How do we compute present value of a cash flow from year 1 to infinity? It's simply the cash flow divided by the discount rates. You can note that somewhere in your book. The present value of a cash flow from year 1 to infinity is equal to the cash flow divided by the discount rate. The cash flow in this question is 4.5 million. Discount rate is 15%. So 4.5 million divided by 0.15. What do you have? That will give us 30 million. That means under proposal C, 22.5 million plus 30 million. Cash flow of dividend from year 1 to infinity. Under proposal C, total present value is 52.5 million. So which one is better now? Under proposal C, the company can get 52.5 million. Under proposal B, bank can get 31.3 million. Under proposal C, bank can get 30 million. Which proposal is recommended for the bank?
Proposal C, sir.
Okay. Because bank we have highest return, Abby.
Yeah, sir.
But look at the comments. Look at the comments. Proposal C offers the highest return, but it is perhaps the riskiest option, or it is perhaps the most risky option. Proposal C offers the highest present value return. However, it is perhaps the most risky option. If the reconstructed company fails to make the expected profits, the bank might only receive 22.5 million naira. On the other hand, if the reconstruction ends in success, the bank will make a profit on its current overdraft investments. Proposal B is marginally preferable to proposal A. Although there must be some risk that Tayo Limited may default on payments of its debt. Proposal A is the least risky option and offer the lowest return. The choice between the three proposals depends on the judgment of the management of Able Bank. In particular, an assessment of the degree of risk of each proposal. We are done with our question.
So I have a question.
Please go ahead.
My question is on the comment, the first paragraph that spoke about proposal C. It says that proposal C, the bank will receive 22,500,000 on the first year. My question is, since the bank is also being offered a 10 million worth of shares, what if they decide to resell the shares on the first year? Won't they be able to get back the 10 million in addition to the 22,500,000 being given to them as cash?
A good question you asked. Now let me pose the question back to you. Let me ask you this way.
Okay.
You are aware that a company is having problem. Will you buy the company shares?
No.
So if bank is willing to sell this company shares to you, will you be willing to buy?
No, sir.
Eh? As soon as a company is having problem, this company is being reconstructed. Bank has been offered 10 million naira, 10 million shares. If bank is trying to sell the shares, bank will go to stock market. At the stock market, there is information that this company is having problem. The share price will have been falling. Nobody will pay anything for the shares. It's like saying you want to bring the shares of all these company that is having problem. I don't want to mention them here now. There are some troubled companies now. Companies are having problem financially. They won't get buyer now.
True.
So if the reconstruction phase, the bank will only get 22.5 million. Any more questions? It's not even wise to bring in new topic now. It's not wise. Look at the assignment I gave you. It's not wise to bring in the next topic. We are going to take it next class next week. I won't deal with source of finance again this night because I didn't even expect that a topic like this would drag this long, really. But all the same, I will encourage you for online class. It's good if you can participate in that class. You can ask questions very well. Look at the assignment we gave. And please try to attempt it. All right. So we have like 30 minutes, but okay, let me even see. The assignments, only for one line. Let me share the assignments. Let's discuss it. Let me check the assignments. I'm going to share the assignments. Let's even analyze together. Why is this assignment out of ordinary? Okay, let me go back to my class.
Okay.
Now look at the assignment we have given. Let's discuss for 15 minutes. Overconfidence Nigerian PSC has the following balance sheets as at 31st December 2012. Goodwill, property, plant, total non-current assets 180, stock and debtors, current assets 90 million, total assets 270 million. Ordinary shares, 1 naira each, 100 million. Accumulated losses, 80 million. That means out of share capital, the company has incurred loss of 80 million. This company is in serious problem. Out of shareholders' funds, company has 100 million. Company has suffered 80 million loss. Preference shares 10%, 1 naira each. 14% unsecured debentures. Trade creditors, bank overdraft unsecured. It is believed that if the asset will realize, it is believed that the asset will realize the following amounts in the event of forced sales. The second paragraph is if the company is liquidated and the asset, if the company is forced into liquidation, the asset will realize how much? Property, 35 million. Plant, 25 million. Stock, 30 million. Debtors, 30 million. Asset will realize 120 million. The directors of the company feel that let me expand this. The directors of the company feel that trading is about to improve, and that if a reconstruction were to be agreed with all interested parties, the company will at least break even. If we agree to reconstruction, the company will break even. That means we will remove all our liability and loss. The company will break even after payment of all interest. After the proposed reconstruction, but before any new investments. The company will break even after we have paid all interest, after the proposed reconstruction, but before new investments. It also has a new project that will generate profit after tax of 6 million on an investment of 25 million in plants. Meaning, if we invest 25 million in plants, we are going to get profit after tax of 6 million. The following proposals are therefore made. Goodwill should be written off. Property plants are to be written down by 40. Debtors to be written down by 36, by 10%. Both ordinary and preference shareholders to be written down by 90%. And the remaining preference shares are to be converted to ordinary shares. Look at it. Both ordinary shares and preference shares will be written down by 90%. That means ordinary shares will be left with 10%. Preference shares, 10%. And then I say the remaining preference shares, that 10% preference shares will be converted to ordinary shares. Next, accumulated losses are to be written off. Trade creditors are to be written down by 50 million, 50%. Debentures are to be written down by 50%, and 20 million new ordinary shares will be issued to the debentures to compensate for this write-down. $50 million of debentures will be written down. And we are going to compensate them with 20 million worth of shares. A right issue of 142. It should be 142. At par, to be made on the share capital after the above adjustment has been made. The bank overdraft is to be increased by 9 million. The bank overdraft is to be increased by 9 million, on which interest will be charged at 15%. 25 million to be invested in plant and machinery. Required. Prepare statement of financial position of the company immediately after reconstruction. That means prepare your post-reconstruction statement of financial position. So if you are to prepare statement of financial position after reconstruction, you are going to do all your workings here. Workings 1 to 9. You now do another statement of financial position post-reconstruction. The B part, explain whether the reconstruction is in the best interest of the following stakeholders. Before you can explain this, you are going to assume that if this company sleep and the asset realize, how much will ordinary shareholder get? How much will preference shareholder get? How much will debentures holder get? How much will trade creditor get? How much will bank get? Then you now say if the company is reconstructed as proposed, what will ordinary shareholder benefit? What will preference shareholder benefit? What will their benefit? What will trade creditor benefit? What will the bank benefit? Then C part. The question has changed now. If the bank should have a fixed charge on the property, the first aspect, if you look at the question, we don't have preferential creditors, we don't have fixed charge, we don't have floating charge, no redundancy payment. That means after realization, you now go to distribution, unsecured creditors. You also have floating charge. Floating charge is not tied to any asset. It's on all assets. So I've tried to explain the question again. Please challenge the question. I can give you solution, but attempt the question. Let me see. By my calculation, this is my third class on capital reconstruction. My first class, when we started, I treated corporate failure and I introduced capital reconstruction. All right. Any question, please?
So this question C, it says explain how your answer would differ if the bank had A, the fixed charge, and B, the floating. The answer they're referring to, is it our answer to B question, like?
Yes, the answer to B now.
Okay.
The answer to B now. Your response in B, we don't have fixed charge now. If you now have fixed charge, that means if you have fixed charge on property, that means any money coming from property, we must apply it to bank first.
Okay.
We must settle bank liability first. That is bank overdraft first.
True. Okay, sir.
All right, may God give us a better understanding. I will be stepping out of the class. Good night. When we meet on, by God's grace, next week, we'll start source of finance. No problem. There's no point rushing the class and we are not able to treat topics successfully. Doesn't make sense. All right, good night.
Thank you, sir.
Good night, sir.
All right, good night.